So, good evening once again. We want to lay emphasis on the group cash flow. And I said under the group cash flow, we have two methods. Under the cash flow, which is the IS7, we have two approach that we can use to tackle this. Number one approach is direct method, while the second approach, it is an indirect method. And this approach, the only thing that make the two approach difference is that of operating activities. How you are going to calculate operating activities when you are using direct method is different from how you are going to calculate operating activities while using indirect method. But tonight, we want to take note of the two approach if we can still manage or micromanage our time. We want to think of how we can use the two approach. But firstly, we have to try the direct method, which is the direct approach. So if you look at this question, they are giving us the consolidated income statement, which is the statement of profit or loss, and also consolidated statement of financial position. In exam condition, this is how the examiner will be giving it to us. They are going to give you statement of profit or loss and also statement of financial position. Any information that you need in your statement of profit or loss, then you go there and pick it. Any information that you need in your statement of financial position, then you go there and pick. That is, we have balance sheet item and the P&L item. Are we following? Are we
Yes.
following?
Yes,
Now,
sir.
when you are dealing with a group cash flow and you want to use a direct method, you want to use a direct method, under your operating activities, you must take note of four certain things when you are dealing with your direct method under your operating activities. Operating activities. Because I told you that what differentiates the two methods, it is the operating activities. Operating activities under your direct method, you must bear four things in mind. Number one, you must take note of the amount. You must take note of the amount paid to supplier. Amount paid to supplier. You must take note of what? Amount paid to supplier. Are you with me?
Yes,
You must
sir.
take note of what? Amount paid to supplier. This amount paid to supplier is one of the key factors when you are preparing your group cash flow using a direct method under your operating activities. Number two is that you must take note of amount received from your customer. So when you are thinking of the amount that you pay to your supplier, you also need to think of the amount that you also collect from your supplier. Another thing is that you must also think of the amount paid to employee, your staff, your worker. You must think of the amount that you pay to them. Then finally, you must also think of the what's it called? Other expenses that you paid, other expenses paid. You must also think of this. In this sense, in this sense, we now say, hello, are we there?
Yes, sir.
In this sense, we now say, hello, are we there?
Yes, sir. Go on, sir.
So in this sense, we now say it is called swap. We call it scale. In this sense, we call it what? Scale. So if you remember this in examination condition, you should be able to know what each acronym stands for. So in this sense, we say when we are calculating group cash flow and they ask us to use direct method under my operating activities, this is what differentiates the indirect method from direct method. When you are computing for operating activity, we call it scale. Amount paid to your supplier, amount received from your customer, amount paid to your employee, and what? Other expenses paid. Other expenses paid. Other expenses paid. So are we there?
Yes, sir.
So looking at this question now, if I want to solve this question and I want to use the approach that the examiner wants me to use, which is a direct method, I will just go by as our normal principle that I will go by, say, the name of the company, which is what's it called? XYZ. XYZ. Then because it's a group cash flow, because it is a word, it's a group cash flow, then you say XYZ PLC Group, PLC Group, PLC Group. Then under it, you now write the title of what the examiner is asking us to do. The title, which is what? Statement. Statement of what? Cash flow. Cash flow. Now put the year. For the year ended. So which year is that? For the year ended, you can see 31st December 2018. The year ended 31st or December 31st, 2018. So then, if you do this, you are on the track because this one also attracts mark. So having said that, under your group cash, under your cash flow, three heading are very, very important. Is the key to this solution. We've already mentioned number one, which is operating activities. Then we think of the next one, which is the investing activities. Investing activities. So, what did I say again? Investing activities, investing activities, investing activities, then finally financing activities. Financing activities. So these are the headings that we are going to use while preparing cash flow statements. And you must put the heading accordingly, not that you will change it. You have to start from operating, followed by investing, and finally financing. Then you can now come here and say you want to write operating activities. Operating activities. Under these operating activities, I've already explained that when you are dealing with your cash flow and you want to use direct method, you need what is called SCARE. That is, you need amount received from customer, supplier, and employee and other expenses paid. So cash paid to, which is amount, cash paid to supplier, which is amount paid to your supplier, amount paid to suppliers. Then you can now check your question whether you are giving the amount paid to supplier directly. But if you are not given directly, then there is a way to calculate that. But for this case, if you scroll down to this question, you look for amount that you pay to your supplier. Look at it. Cash paid to supplier, 8,625. But if the examiner did not give you the cash paid to supplier, then you will use what is called control account to tackle that. You will use control account to tackle that. You use control account to tackle that. And if you want to use control account, let's assume I did not give cash pay to supplier, and the examiner want me to calculate it. I will use control account like this. I'll put the heading as cash paid to supplier. Then I'll come here and say balance brought forward. And this balance brought forward, what you are going to put here, you now go to your balance sheet and check your trade receivable. Trade receivable. You put the opening balance of trade receivable, then you come to credit side and put say balance carried down, balance carried down, balance carried down, and put the closing balance of trade receivable here. Then after that, you now come here and say sales, sales, which is your the revenue. Then you put your sales here, which is the revenue. You put it here. The revenue, you put it here. So by the time you put it, then you add, and so you add the two sides and look. When you add the two sides, then look for the difference. The difference is your cash paid to supplier. Cash paid to what? Supplier. So the cash that you pay to your supplier, then, sorry. So if you go to your, what was it called? The balance sheet, then you look for because this time around you are paying cash to your supplier that you are not received. Then you now come here, because you are paying to supplier is the purchases. Sorry, this is wrong. Then you say purchases. The examiner will give you purchases, then you put it here. Then here will be balance brought forward of a trade payable. Sorry, it's my mistake. Balance brought forward of trade payable. I'm thinking other things. Balance brought forward of trade payable. Then this one will be balance carried down. Balance carried down of what? Trade payable. Then you do plus and minus, or this one will be purchases. When you do plus and minus, the difference is the cash that you pay to your supplier. Is the cash that you pay to supplier. Is it clear? Is it clear?
Come again,
Take
sir.
that last part again.
Take it again, sir.
Okay. What I'm saying is, let's assume the examiner didn't give you the cash pay to supplier, but you need it. Automatically, the examiner will give you the information that you are going to use to prepare that. And I said this is my mistake before because I'm thinking other things. Then when you do your T format like this, you say balance brought forward. And this balance brought forward, you now go to your balance sheet and look for your trade payable. Trade payable. When you look for your trade payable, you put it here. Then the same balance sheet, the same trade payable as a closing balance. You know we have opening balance. That is, they are going to give you 2 periods like this. Let me show you balance sheet here. Look at the balance sheet. They are giving you 2018 and 2017. Then you just come there and say, look at it, payable. You go to your opening balance, which is what is it called? Opening balance is 2017, closing balance is 2018. So then you put your opening balance of payable, closing balance of payable, then you now put purchases here. Purchases. The examiner will give you purchases, then you put it here as well. So when you now do addition, automatically maybe this side is greater than this. The difference of the two sides will be your cash paid to supplier. You just come and put it here. But in this question, the examiner is not disturbing us. He's already giving us the cash paid to supplier. Just copy the figure and put it here. Is it clear? Is it clear now? Hello?
Yes, sir.
So cash paid to supplier, just put it here. 8,625. So because you are paying the money to supplier, you have to bracket it because the money is going out of your business. You have to put bracket because you pay it to supplier. You have to bracket it. Then after supplier, I said, if you remember these acronyms, I said customer. So this time around, you are not mentioning cash to supplier, to customer. You say cash received because you are the one receiving now. Cash received from customers. Then you go there again and check. Look at it. The examiner is already giving you cash received from customer. But if the examiner is not giving you and you want to calculate it, obviously the examiner will give you the information that you are going to use to calculate it. Then what are the information that you need to calculate cash received from customer? You do your T format as well. It's just the opposite of the one I did before. Then you come here and say balance brought forward, and go to your balance sheet and look at your trade receivables. Opening balance, then come here and the same trade receivable closing balance, which is a balance carried down. You put it here, Then you now come here and say revenue, which is the same thing as sales. Revenue. The examiner will give you revenue in your statement of profit or loss. Look at, you can see that it is opposite of what I did before. Then you add it, and look for the difference. Look for the difference of the two sides. The difference that you are going to get will now be your cash receipt from your customer. Cash receipt from your customer. But here, the examiner is not disturbing us. He's already giving us the cash receipt from customer, then just pick it straight away. 19,650. So this 19,650, you don't need to put bracket because the money actually came to your business because you received the card from your customer. Any question before we move on? Is it clear?
It's clear, sir.
Am I talking to one person? Is it clear? Everyone know.
It's clear.
Yes.
So let's now move to the third one, which is E. Amount paid to employee. That is what you pay to your staff. Cash paid to employee. Cash paid to employees. Then you go to the question, to the examiner, we give you what they paid to the employee. Are we there? You can see this is what they pay to employee, wages. Can say salary and wages is what they pay to what employee, which is a 60/75. Salary and wages, they can mention salary and wages, it's still the same thing. 60/75. 6,075. The money is going out of your business because you pay it to your staff. Is it clear? Then the third one is what? Other expenses. Other expenses paid. Other expenses paid. Then you can see other expenses given to us, which is 1,760. That's the other expenses that we will pay. 1,760. And because we pay the money is going out of our business, then we have to put bracket. So after that, then you are good to go. By adding it. So who can add for us? Hello. Hello. Hello.
Hi.
So who can add for us so that we get the figure?
I'm on it.
Okay.
$3,190.
3,000.
190.
3,190.
No, it's 2,760.
This other should confirm this.
It's 3,190.
3,190.
Yes, it's 3,190.
3,190. Is it positive or negative? But you have to be sure.
Positive.
So that
Positive.
positive. So we don't need to bracket it. So after that, then we can now think of finance cost. Finance cost. Finance cost, or we call it interest expense. Interest expense paid. interest expense paid. So where you will see your finance cost or interest expense paid, you are going to see it from your statement of profit or loss, which is the income statement. You look at it, interest expense. How much is that? You can see interest expense, 300. Then you bring it here because you paid it, because it's an interest expense that you paid. Then you jacket it because you actually pay that. So what do you have?
2890. 2890.
2000, sorry, 2890.
890.
So after getting your interest expense paid and you have your 2890, then the final touch under these operating activities is now to check your tax, the tax paid, the tax that you paid, the tax that you what that you paid, which is your income tax paid. So in some cases, the examiner can give you, and in some cases, you have to calculate it if the requirement warrants you to calculate. Let me now tell you the way in some cases that you need to calculate. Normally, if you want to calculate, let me draw it here, but I'll clean it. If you want to calculate, let me put it somewhere here. If you want to calculate the tax that you paid, you have to do the account, tax paid. You have to do the account like this. You go to your balance sheet because you are going to see tax in your balance sheet as a what? As a liability line item. You will see it under your current liability line item. Then you come here because the liability needs to be credited. Then you come here and say balance brought forward, meaning opening balance of tax in your current liability. You put it here. Then you come here, you say balance carried down. You know, there's opening and closing. Balance carried down is your closing balance under your liability, the tax, the closing balance of that tax. You put it here. Then you now go to your P or L, statement of income, P or L, the one I show you just now, this place, P or L, income statement. You now go there and pick the taxation that is there given to you. That's why we call it P or L. The taxation is the taxation in your P or L. Where is it? You can see taxation in your P or L. How much? 50. You put it here. You put it here. You now add. You add. By the time you add, then you subtract. The difference is the tax that you paid. Are you getting it? The difference is called tax paid. The difference of the two sides is called tax paid. But now look at this scenario now. They are not giving you if you check your balance sheet, they are not giving you under your current liability. They are not giving you tax. Can you see? Hello, are we there?
Yes.
Hello.
Yes.
So they are not giving you tax under your liability. That is why you don't need to do working for taxation. Just pick the 50 that is here and put it here. That's the tax paid, because they are not giving anyone in your balance sheet that you want to, that will make you to do the adjustment. You just put the 50 as the tax paid. Then you subtract so that you are done with the operating activities. So whatever you get, if it is positive, you say net cash inflow. Let's assume whatever I get, if it is positive, I will call it net cash inflow. But if it is negative, I will say net cash outflow. So what do you have? Is it positive? Okay. Net cash inflow from operating activities. But let's assume it's a negative. I will say net cash outflow. So what do you have?
2,840.
2,840. So then we are done with the operating activities. Then we now move to investing. We move to investing activities. Are we getting it?
Yes, sir.
Yes.
Investing activities. So under this, your investing activities, this one is actually telling you that what and what do you invest your money on? You can invest your money by way of acquiring assets. That is by way of what? Buying assets. So when you buy assets, you actually invest your money. Not only that, under the group cash flow, you can also acquire, as a parent company, you can also acquire a subsidiary. You also invest your money. Are we together? If you acquire a subsidiary by way of maybe you buy a shares, you invest your money. If you buy assets, you invest your money. Do you get my point now? So these are the things that you need to be checking under investing activities. Then when you now buy a shares, you are expecting to get a return from the shares that you buy, that you acquire. You are expecting to get a return, and that return is called dividend received. So if you have something like that as dividend received, then you are putting it under investing activities. Not only that, you can also have something called interest received. Then it will be part of your investing activities. Probably you invest on something, you invest on certain thing, and you are receiving interest. Then it will form part of your investing activities. Or probably there is a sales of assets. Maybe you have an asset and you now decided to dispose the asset. So when you dispose the asset, the sales proceed of that asset, it will form part of your investing activities. I'm not saying profit of the asset now. I'm saying the sales proceed. That is, when you dispose the assets, what the buyer pays you. Then assuming you dispose the assets 40 million naira, and the buyer pay you 40 million naira. That 40 million naira is called sales proceed, and you are taking it towards investing activities. Take note of that. I'm not talking of the profit now. I said sales proceed. The amount that you received from disposing your asset, we call it sales proceed. Then it comes directly under investing activities. Are we there? Is it clear? Is it clear?
It's clear.
Yes,
Yes.
it's clear.
Yes.
So, excuse me.
Please drink water. I'll drink water. Put water beside you, please.
So these are the things that you need to be checking while computing for your what investing activities. So let's go there and let's bring out everything that we mentioned under investing activities. Then we go to our question once again and look at everything that we just said. We mentioned acquisition of assets or acquisition of a subsidiary. So let's think of the asset. You have to think of the asset. That do we acquire assets? If we acquire assets, it means that we purchase assets. Let's check. So it doesn't mean we can, okay, I can see purchase of tangible assets. You can see purchase of tangible assets. Purchase of tangible assets, 2,100. Purchase of tangible assets, 2,100. But in case if the examiner didn't give you the value directly, you have to do working for that. Automatically, the examiner will give you some information that you need. The opening balance of the asset, closing balance, depreciation, if there is a revaluation, if there is disposal, then you do the adjustment, then the difference will not be the amount that you pay to purchase the asset. Is it clear? Is it clear?
It's clear. It's clear.
Others, is it clear?
Yes. Please give us a sample of that. What is it called? What did you just mention now? Example of
Okay,
the adjustment. Sorry.
okay, the purchase asset, right?
Yes, sir.
So let's assume the examiner is not giving you, then you draw it and write the PPE that you want to calculate. Then because asset has to show a debit balance, the opening balance of it will be here as balance brought forward. Then you go to your balance sheet and check what is the balance brought forward of the asset. Then you come here and say balance carried down in that balance sheet as well, which is the closing balance. Closing balance, you put it here. If there is a revaluation, maybe if it is upward revaluation, then you put your revaluation. If it is a disposal, you put your disposal here, because it's disposal means you've already disposed the asset and it has to reduce the current position of your asset. Then if there is depreciation, you put the depreciation here. So by the time you now do your plus and minus, the difference will now be your the payment that you made for the new asset. Is it clear?
Yes, sir. Thank you.
So another thing that we can think of based on what I mentioned, the purchase of assets, maybe if there is a dividend received, interest received, then you can see acquisition of subsidiary. You acquire a subsidiary, is part of your investment. It's part of your investment, then you put it. So this one, purchase of tangible assets, you have to jacket it because of what? Because you purchase asset, your money is going out. Then acquisition of subsidiary, how much do you pay when you acquire that subsidiary? 40. You have to jacket that one as well. You have to jacket it as well. Then what other thing that I mentioned? I said sales proceed. Do you dispose your asset? If you dispose your asset, to be there. If you didn't dispose it, then no problem. You look for other things. Do you acquire a new shares? If if you acquire a new share, you have to put the value of the amount for that acquisition of the new shares. Then if you don't have that, then it means that we don't have any other information. If we don't have any other information, then we can cast. So what do you have? That is that person should move.
2140.
2140. So this 2140, you put it in jacket because the two are in jacket already. So this 2140 will now be your what? Net cash outflow. Net cash outflow. Because it's a negative result. It's a net cash outflow from investing activities. Investing activities. Hope is clear. Can we move on? So, financing activities. So these financing activities is the last heading that we are going to do under the cash flow. Then what these financing activities is talking about is that of you want to finance your business and you need a lot of things for your financing. Number one is that it can be in form of money, that you want to finance your project and you don't have money, you go to the bank and bank will borrow you money. So meaning if there is a loan in the question, or probably the venture, it will form part of your financing activity. Number one. Number two is that if the examiner is telling you that you are issuing a shares, probably you don't have money to finance your business, that you now think of, how will I raise capital? Then you now say, okay, let me issue shares to the public. When you are issuing shares to the public will subscribe and pay you money. Then you use that money to finance your business. So it means that issue of a share is different from the investment activity that you are the one that will buy a share. This time around, you are issuing a shares, then to form part of your financing activities. Then another thing that also open to you is that if you finance your business and you issue a shares to the general public, what is the return of the general public? The return of the general public is to do what? Are we there? The return of the general. Hello, are we there?
Yes, we are here.
The return of the general public is that you have to give them what is called dividend. And that dividend that you are giving them, we call it dividend paid. Dividend paid is different from your own dividend, that if you acquire a shares, then you can say your own dividend will be dividend received because you are the one that acquire shares. They will pay you dividend. We call it dividend received. But this time around, you want to issue out shares and people came to buy. Then you have to give them what is called dividend paid. If you have similar thing like that, you have to put it under your what? Under your financing activities. And not only that, if you borrow money, I say you have to put it under financing activities. The examiner can mention loan notes, he can mention debenture, he can mention long-term loan, bond. So all these are what? Under financing activities. Then all this loan that I'm talking about, probably or peradventure you want to repay the loan. You want to repay the loan. So amount of you at the amount that you want to use to repay that loan will also form part of your financing activities. Financing activities. Then let's look at our question and let's see everything that I mentioned, whether we are going to what's it called? Whether we are going to what's it called? Whether we are going to see them or not. Are you with me? Hello.
We are still
We are
here.
here.
Okay. So so we mentioned debenture. Where can we see that one? Where you will see your debenture is your balance sheet item, your loan. You can see long-term loan. Long-term loan. I said they can mention long-term loan or debenture or loan notes. Then you put it here. So you now look for the opening balance and closing balance. So let's think of how it works. 2017, that's the opening balance. It means that there's a loan, long-term loan that you took 3,000 naira. Then in 2018, in 2018, are we there? Hello.
Yes, we are
Yes, we
here.
are.
In 2018, it has come down to 2007. Who can tell us what really happened when you borrowed 3 million and it has come down to 2000 and 2,700? If you borrow 3,000 in 2017 and it has come down, that person should move, please. 3,000 in 2017 and it has come down to 2,700 in 2018. Automatically something has happened. Then anybody that want to talk, just raise your hand and I will grant you permission to tell us what is actually happened. Okay. Cassandra Kenny and Sarah Ojo. Okay. Let's that Ojo talk first. So what actually
Okay.
happened?
It means that part of the loan has been paid. That's why we
Okay.
have a reduction in the loan in 2018.
Okay. So Kassan something. So that person should also talk. What's your opinion there?
She have said it all because what that implies is that part of the debt has been paid.
Okay. So as the case may be, then so what you are going to put here, we call it repayment, loan repayment. Are you getting it now? Loan repayment. Loan repayment. Repayment of loan. Repayment of loan. Repayment of loan. By that difference. So repayment of loan by that difference. The difference is what? 300. Because if you say 3,000 minus 2,007, you actually have 300. So we call it repayment of loan. But now, the question now is that, are we going to put it in brackets or we don't need to put it in brackets? Who can answer this one too? Just raise your hand and I will call you. You can raise your hand, then I'll definitely call you to to share your opinion or your reasoning behind whether to put the bracket or not. So Sarah Ojo as well. Go ahead, please. Sarah Ojo, go ahead, please.
Okay, I said it's going to be in brackets. It's going
Why?
to be negative since the company is here to pay their debt, is here to complete their debt rather.
Okay. So another person should try. Another person should try. Why are we putting 300 in bracket, or we don't need to put it in bracket? Another person should try. Okay. Is there anybody raise hand? Okay, Deborah. Okay, go ahead. Ask your question. Go ahead, rather. Share your
My opinion is that it shouldn't be in bracket because that 300 has been settled out of that 3,000 naira. It has been settled.
Okay, another person. You can mute yourself. You can mute yourself. Thank you. So another person should also try. Let's see. Adewale Yinka. Okay. Adeyinka, go ahead. Adeyinka, go ahead. Okay. In the absence of, because I can't hear you. Folorunsho, you can. Okay. Folorunsho has spoken. Who again that want to try?
Hello,
Am I going
Mr.
to?
Ibrahim, sir.
Okay, go ahead, please.
Okay, that was the first this thing I answered. It was actually a mistake. It's not going to be in brackets because the company has paid part of their loan.
Okay, thank you. So all of you tried, but this is what you are going to do to it. That 300 naira, you will put that 300 naira in brackets, and I will tell you the reason why it will be in brackets. The reason is when you borrow money in 2017, 3,000, and in 2018 you now discover that money that you borrow, it has come down to 2007. Automatically you've already paid 300 naira. So this 300 naira is what you paid, and it's going out of your business. Is it clear?
Okay.
Is it clear now?
Yes.
Okay.
Yes.
So it's going out of your business because this is what you pay. It's definitely going out of your business. So let's move on. Another thing that we also need to think of is that, do we have any dividend paid? If there's a dividend paid, then because I said the dividend that we paid need to come to where? To our financing activities. If there's a dividend paid, if there's a dividend paid, if there's a dividend paid. But the examiner is already giving us what? The dividend paid, which is what? 150 dividend paid. Dividend paid. Dividend paid 150. So this dividend paid, is it going to be in jacket or is it not going to be in jacket? Who can answer that? Okay, go ahead. Ask your question. Answer that. Go ahead. I've already granted the permission. You can talk. No problem. Anybody that raise and talk. Dividend paid of that 150, is it going to be in bracket or not? Go ahead, please talk. Mr. Semim.
Okay, my opinion is the money comes in, so it should not be in jacket because we receive cash.
The money goes out. Supposed to be
Yeah,
in
the
jacket.
money is not actually comes in. We pay dividend paid. I've explained that under your financing, you are the one that you want to finance your business, and you are issuing out shares for people to come and buy. And if people buy your shares, you have to give them a return, which is called dividend. So that dividend that you are giving them, we call it dividend paid. Then it's out of your business. That money is out of your business. Then you are putting a jacket. But let's assume under your investing, you are the one that you want to invest. You go outside there, maybe you go to UBA bank that, oh, UBA, I want to buy a shares. Then when you buy that share, UBA will give you a return. We call that return, we call it dividend received. So as a result of that, you say if it is dividend received, you don't need to jacket it because you are the one receiving it. But this time around, you are the one paying that dividend, so you have to put a jacket. Is it clear? Hello?
Yes.
Yes. That place is not clear. Oh.
Which place is not clear? I've explained. Just mute yourself, please. Mute. I've explained dividend multiple times. We have dividend paid and we have dividend received. As the name implies, when they say something paid, it's going out. When they say something received, it's coming in. And I said you will put dividend paid under your financing activity. Then when you paid something, the money is going out. You put bracket. If it is dividend received, it will be under investing activities. Then you don't need to put bracket. Is that clear now?
Yes, yes, sir.
Then what other things that I mentioned under your financing activities? I said if there is a long-term loan borrowing, maybe in the additional information, they are telling us that there is a long-term borrowing loan, then we know that we borrow loan. Then if you borrow loan, you don't need to put bracket because what you borrow is actually part of what you receive to the business because you borrow that money. That money is coming to the business, so you not put bracket under that financing activities. So okay, we don't have any other information aside from if we now have what is called what's it called? The loan that I mentioned, that I said in additional information, probably they are telling you that there is a loan that the company took, then we can now think of. So what do you have when you pass this one? Is it a negative? We call it net cash outflow from financing activities. So which is a 3,150. 3,150. So then you cannot cast from the beginning, from operating, which is this from here, followed by investing, and followed by financing. You cannot cast there. So cast the 3. So what do you have?
Ibrahim, that thing is 450, not 3,150.
Hey, sorry, thank you. 450. So you can now cast the 3. So when you cast the 3, if it is a positive answer, you will say increase in cash and cash equivalent. But if it is negative answer, you call it decrease in cash and cash equivalent. So is it positive answer or a negative answer?
It's positive.
Positive of how much?
250.
250. Then I would say increase in cash and cash equivalent. Increase in cash and cash equivalent 250. But let's assume it's a negative answer. We call it decrease in cash and cash equivalent. Then after that, I would say add opening balance. Add opening balance of cash and cash equivalent. Add opening balance of cash and cash equivalent. So what makes your cash and cash equivalent opening balance is actually from your what's it called, from your balance sheet. But because what's it called, in some cases you have to check your balance sheet item, then under your current assets you can see cash. Sometimes the examiner can mention bank. It's not necessary that they will say cash. They can say cash at bank. So that's where you can now think of your cash and cash equivalent now, opening balance. So opening balance is actually your 2017. Look at the cash of opening balance of 2017. It is 300 naira. So the closing balance, it is 550. That is what the examiner is actually talking about. But if you don't want to look that, because I'm only giving you the concept of where you will see it, you definitely see it from your balance sheet. Then if you don't want to look at your balance sheet, you can come to the draft that the examiner is giving you here, this cash account. You can see balance, this cash account, balance brought down 300. That 300 that you see in your balance sheet here, under cash and cash, and this 300 that you see here is the same 300 that you have here. Don't go and add it. Don't add it together. The same 300 that you see here is the same 300 you have in that balance sheet. On your closing balance, which is the 550 in 2018 that you see here, is the same 550 that you are going to see in your cash account, which is balance carried down. Can you see? Hope it's clear. Then you come here and say opening balance of cash and cash equivalent 300. So by the time you now add 300 and the 250 together, you must get exact that 550. That 550 that I show you just now. You must get this 550. You can see closing balance. You must get that 550 that I showed you. So it means that when you add it, you now have what you call cash and cash equivalent at the end. Cash and cash equivalent at the end. Meaning this one, the one I had is cash and cash equivalent at the beginning, while the one that I will get will now be at the end. At the end. So if you didn't get that closing balance at the end, automatically something is actually wrong with your calculation. So let's assume I want to know from the beginning, I will know exactly what I'm going to get at my increase in cash and cash equivalent. So is it clear? Is it clear?
Yes, sir.
Okay. So any question before we call it a day? So probably tomorrow, by the grace of God, we are going to look at the second method, which is called indirect method. Indirect method. So let me take a rest. So any question before we call it a wrap? Any question?